fresh hope for home buyers this morning, with lender Pepper Money expecting to introduce the first 40-year mortgage plan in Australia.
Well, the move's designed to reduce monthly repayments, of course, though it could end up costing you more in the long run. To break it down, we're joined by Michael Beresford, Director of Investment Services at OpenCorp, live now from Melbourne. Welcome, Michael. Now, apart from being longer, how is this 40-year-old plan different to your typical mortgage?
Morning, Nick. Well, look, it's really very much the same as a typical 30-year mortgage. It's just for 10 years longer. There are a range of benefits to it. The first is that, obviously, because of the longer loan term, the monthly repayment will be less. So that can be great for your cash flow. The second reason is that it will improve your borrowing capacity. So if you're one of those people out there that have been trying to get into the market, this might be the opportunity to do that, because you will be able to borrow that bit more. And finally, the third and the main benefit is that it will allow you to be able to get access to the market sooner. By having that higher borrowing capacity, it will allow you to be able to get into the market. And what we often see when there are offerings like this introduced to the market is that it acts like a little bit of a sugar hit, and the market will move based on that increased buyer demand with that increased borrowing capacity.
So, Michael, as they say, if it sounds a little bit too good to be true, it probably is. What are the downsides of this?
Very true, Lara. You've got to consider the full picture for sure. So, obviously, the first one, as you said, Pepper are the only lender at the moment that have launched this. It's not widespread through the market, so you are a little limited on lender options. The second one, and the most obvious one, is that you are paying more interest overall over that 40-year loan term. Now, there are some ways that you can mitigate that, so all is not lost there. But the one that most people aren't aware of is that we're going to see prices rise as a result of this kind of loan product becoming available. Because as you increase buyer demand with more borrowing capacity, prices will move up. You know, the median house price can increase or decrease from time to time, but the entry point of the market always increases. And so those people that have the ability to be able to buy and can get access to the market earlier will see some amazing benefits. Those that can't or decide to sit on their hands will actually be further away in the future than what they are today.
Yeah, well,
those are some downsides.
There are some downsides. but if I was looking to enter the market now, I didn't want a 40-year-old loan. What other sort of strategies or options should I be considering?
It's a great question, Nick, and over the last couple of years at OpenCorp, we've been inundated with people looking at creative ways to enter the market. The most common one is rent vesting, which is gaining a lot of traction. It makes a lot of financial sense, and that is choosing to rent where you want to live and being able to build a property portfolio focused on more affordable properties, because let's be honest, not everyone can afford to buy where they would love to live, especially at the start. And you know, OpenCorp clients Matt and Christy have been with us for about 4 years. They've made $600,000 from their investment portfolio, and they continue to live Bayside here in Melbourne and love their lifestyle. The other most common one is the bank of mum and dad. So parents being able to tap into equity in their own home and gift that as a deposit. We've seen that increasing in popularity, and an OpenCorp client, Pascal, has done that very well. Borrowed some cash from mum and dad to top up the deposit that he'd saved. He got into the market a couple of years ago and has seen $250,000 worth of uplift in that time, and is in the process of buying his second property. So on top of those options, you can co-invest with someone who has the similar property goals that you do. And if you're an existing homeowner, you can harness lazy equity, which is equity that you have in a property that you're not currently putting to use to be able to improve your financial situation, which is also a great option.
Yeah, wonderful advice there, Michael. Thank you very much.
Coming up on Today, police